guys, we're live now. Welcome. Thank you so much for taking time out of your night. I really appreciate it. We're gonna do this super quickly because I know it's late. So if you guys have any additional questions or if there's anything else that you're wanting to maybe spend a little bit more time on, feel free to schedule a call with us one-on-one. We're more than happy to go over any information with you guys. Another great opportunity, and I will add the link to our chat. If you create your investor portal and you join the community, you have two options. So you can join the investor portal once you've decided that you want to start investing. And that's where you'll see all your documents and everything. We spent a lot of money on that investor portal, so make sure that you guys take advantage of it. And if you just want to get information about our upcoming deals, you can go ahead and join the investor community, and you will receive information before anybody else does about any upcoming deals we're doing. So today, we're going to be talking about one of our newest opportunities that we are now under contract on. It is in the Texas real estate market, and we are extremely excited because Texas just continues to be one of those powerhouse areas for growth. It's just one of those places that it's got amazing returns. It's a strategic location. It's a great opportunity, and one of the things that we strive on is making sure that we find those really good opportunities. So Sanjay is going to be presenting the pitch deck for us. We're going to go over a lot of information. Feel free to stop us at any point on a specific slide if you just want Sanjay to elaborate a little bit more on it. It's very informal, so just go ahead and unmute yourself and just say, "Hey, Sanjay, let me ask you a question on this particular matter," or go back on that slide. Anything you guys need, just let us know. We're here to help you. Sanjay, take it away.
Okay, awesome. So let me know when you can see my screen.
Mm-hmm. Okay, I'm seeing it. I'm seeing the last page.
Yeah, no, well, there you go. You just saw the screen. Now forget, you're done. You're done with the screen.
That's it. You saw everything.
Okay, guys.
Do you want to go to the first page?
Yeah, this is the first page. Are you seeing the first page?
West Texas Portfolio Investment Opportunity, yes.
Okay, so that's the first page.
Yep.
So thank you guys. I know it is for those who are in the East Coast, it is pretty late in the night. You probably are sleepy, and trust me, I have a very soothing voice, so that will put you to sleep. So if you are awake by the end of this presentation, I thank you from my heart. Okay. I try my level best to try to keep my um, pace very slow. It's because I have an Indian accent, and if I talk very fast, people will end up not understanding what I'm saying. So I do my best to, keep it at a medium pace. With that being said, let's jump into this opportunity, which is a great, great, great opportunity. We are buying two apartment buildings. Okay. As you can see, one is in Big Springs, which is 112 units. And then there is one in Loveland, which is a 64 unit. We are buying both of these portfolios under one property, okay? Because it's all both sold by the same seller, okay? Obviously, this is the 2 cents that has been given to me by my SEC attorney. This is obviously there to protect myself and you guys, because our goal is always to protect our investors. And obviously, I'm not going to read through the whole thing, but then, this is something that we have to tell everyone, that the presentation contains privileged and confidential information, and unauthorized use of this information, in any manner is strictly prohibited. Obviously, we are trying to let everybody know that every investment comes at a risk and so on. So you got to do your own due diligence. We have done our due diligence, and we are here to answer any of your questions. Okay. Obviously, it's the same thing, contains future financial projections and forecasts. So if you have any questions about, hey, where did you forecast this from? Do you have this, some sort of a voodoo kind of a thing which tells you where you get these numbers from, and so on. We are here to answer all of those, okay? So we'll be going over the, investment highlights, property overview, and so on. And I think the most thing that which is more interesting is the management team that you should be knowing about, because there are so many syndicators out there, just like myself, Catherine, and the others. But what sets us apart is our management team, because I'm a very firm believer of, like, you can have a great plan, but if the execution is not there, it's useless. You can have the greatest of the property, but if the management team is not the right team, then they can take one of the greatest properties and, pardon my French, screw it. Investment highlights. Okay, so this is where I think everybody has to look at it. And the key to this entire thing is, what are we buying this property at? This is an amazing, amazing. Um, um, can you see the screen?
Yes, we can see it.
Okay, because I'm seeing myself right now.
Yeah, no, we can see it. Investment highlights, purchase price, number of units.
Oh, okay.
Yeah.
Awesome. Okay. So I tell this to everybody, even though I'm an Indian, everybody thinks that I should be an IT wizard, because that's what most of them are, but I'm not. I'm a pharmacist by education, right? And then I got into multifamily. But here you go. So I'm glad, thank you, that we're back on the screen. So this is where the entire thing kicks in. We are buying this at a price that is so good. Like, two properties, we are buying it at $7.6 million, 176 units. What does that really mean per unit? When the rest of that properties in that area is selling at like $90,000 and plus, we are getting it at $43,000 per unit. This is the biggest thing, okay? That's what is helping us in this entire thing, okay? We are getting it at a really, really discounted price. And that is the key to this entire thing. It's 176 units, as we say. And you know what the best part about this thing is? Look at the vintage of this property, 2005, 2008. Imagine getting it at this kind of a discounted price. It's uncalled for. You will see this when we actually go over these slides, that this is a great property, and why this is going to be a good investment for you guys, because we'll be talking a little bit about the comps later on. So what is the whole period? Of course, we're going to hold this for 5 years, and the total equity raise that we're going to raise for this is $3.8 million. We normally have Class A and Class B shares, but in this Class A and Class B, where Class A is the limited partners, which is the investor, and Class B is usually us, the operators. In this case, we have created Class A, Class B, and a Class C. Okay. So what does it mean for those who want to invest in Class A? And why did we create this is the question. There are a lot of people who always say, I need a guaranteed, 10% annualized return on cash. They don't really, and I wouldn't use the word they're short-sighted or far-sighted or anything. I would just say there are different types of people depending on investors, depending on their age and everything. There are a few people who are like, I want to see my money right now. And then there are some people who are like, hey, I'm young enough, I can wait for the thing. So we wanted to accommodate both kind of investors. So when it comes down to Class A, we also, but at the same time, we limited ourselves okay, at only raising $575,000. So if you are one of those who want to be in the Class A shares, start putting your money right now, okay? Because this is going to get filled up very quick, and we have a very small amount that we are raising out of that $3.8 million, okay? So I would say, but what does it mean? And the beauty about this thing is the depreciation year one, whether it is Class A or Class B, you're, both of them are going to get anywhere between 30 to 35. The actual depreciation we will know only after we close the property, but at right now we are estimating it to be between 30 to 35. Okay.
Jay, can you go over a little bit of what depreciation is for those of us who are newer and don't know that?
Absolutely, absolutely. So when we buy a property, right, and multifamily comes under commercial property, right? So according to the real estate, commercial real estate, the life of the structure, which means the structure of the building, right, not the land or anything, just the structure, is about 27 years. Okay, and what we can do is that you can take all of that 27 years depreciation in the year one itself. Okay, so that's the beauty about this one. Okay, so that's what it is. So that's where it comes down to 30 to 35. Then there are other things that we also come in, which is called as cost segregation. That will come later on. Because once we buy the property, then we put in all these upgrades, such as new carpets or new flooring or new appliances. All those things will depreciate as well, and that goes through a cost segregation, right? A new HVAC. Obviously, we're not going to replace all the HVACs, right? We'll only replace some of the HVACs and so on. So those go through a depreciation as well, which comes under cost segregation. So there are two types of depreciations that the investors get. Okay, so that's what. But this one, year one depreciation that we're talking about is on the structure by itself. Okay, but what does it mean for someone who is investing in Class A shares? They're trying to say, they're going to get 10% annualized. What does that mean? Is this what we're going to do is, because it takes us time for us to stabilize the property and so on, we are saying in the year one, okay, we are going to give them only half of what we would, like, it's basically it's going to start off like in the third quarter, right? So third quarter and up. So they'll get 2,500 in year one, but as you see, that remaining $7,500 is coming on year five. Okay, so we're gonna give it to them at the back end. Okay, so you get in the year one $2,500, year two 10,000, and so on until year five, you get $17,500, which for an investment of $100,000, you get $150,000, which, if you really look at it, it averages out to 10% annualized return on cash. The only thing that you will also notice is that there is no back end. Okay, there is no 2xing your money and so on, which we will get if you are going to be a Class B member. Okay.
So, question, you explained depreciation, love that. Why, as an investor, would I care about depreciating this asset?
Repeat that question, please.
Of course. You explained depreciation and what it is, but why do I care about depreciation as an investor?
Absolutely, because the first thing is that you make money, right?
Mhm.
So that's a good thing. We all love making money. Now, do you want to pay taxes? So one part of it is making money. The second part of it is saving on that money, right? So these depreciation are pretty much helping you to, because you are making money in real, but on paper,
Mhm.
you are losing money on paper, right? So what happens is when you go to your tax accountant while you're paying your taxes, guess what? You end up paying little to no taxes on the money that you earn. Does that make sense?
Okay, so what you're saying is if I make, let's see, year two, I'm making $10,000 and then you give me depreciation. So I don't necessarily have to pay taxes on $10,000 because the depreciation will lower that for me.
Absolutely. And again, I have to give a disclaimer over here. Neither me or Catherine are CPAs or tax consultants or
Yeah, we don't
financial
want to be.
advisors. Okay. But yes, in a nutshell, whatever you just said, that is true because it will be whatever the depreciation is will be applied towards your earnings, and you will not. It will be taken against your the capital gains and so on. So yes.
Okay, so that's just one of three. I like to summarize it very simple so that for people that are learning or just getting into this investments, they can understand a little bit better. So the depreciation is one of the three main reasons why investing in syndications and apartments is such an amazing opportunity. So depreciation being one, the second being that you get your quarterly distributions, and then the third one being if they choose Class B, that they get to get that money on the back end.
Yeah. So thank you. So that takes us into Class B shares. What does that mean? So basically, in Class B, you have two ways of earning, right? One is through the cash flow, okay, and then there is another one on the back end, okay. So obviously, it's a fully participating. It's a 65-35 split when it comes down to the bonus depreciation on year one. It's going to be 30 to 35%, just like how it was in Class A. And the total Class B shares is limited to $3.2 million because the remaining $5 500,000 and odd is in Class A shares, right? So, but what does it mean for a person who's making an investment of $100,000? So, in year one, okay, because we are saying that we'll be giving a 6% average annualized cash on cash, in year one, they'll make $1,500, just like how Class A was. We will be doing the first, 3 quarters will be paid off in the end of the year, end of the fifth year. But what does it mean is the year two, they'll make 6%, 6%, and 6%. But here where it is, they also get a investment equity share of say $70,000 because it's a 65-35 split, right? So that is where they have an advantage on this one. They make a little bit lower on the cash flow, the cash on cash, but they make up much more for it by 2xing their money on the equity share. This is where I say it all depends on every individual about how each of them look at it. Most of the people who go with the Class A shares are the people who are investors who are in their early 60s and so on. And most of the people who come in Class B shares are usually, in their 40s and so on. So because they feel that, okay, hey, you know what, I can wait for my money and so on. But what I would suggest is it would be a great one for those who want to have best of two worlds, right? They'll say, hey, I'm going to put in, say, for example, this $100,000. They would say, hey, I'll put $50,000 in, or $20,000 or $30,000 in Class A shares, and I'll put in $70,000 or $20,000 in Class B shares, because that way they have best of two worlds. They're also limiting their risk when it comes down to the investment. So that is absolutely doable, and I would definitely encourage those who want to make an investment in this to do that. So basically, in this one, you're pretty much 2xing your money with $100,000 of investment, with $30,000 in cash flow and $70,000 on the back end. Boom, you made another $100,000 on top of your initial investment of $100,000. So you would just 2x your money. Okay.
Before we move on, does anyone have any questions about the difference between Class A and Class B? I know it's probably new for some of you, so I want to make sure if there's any misunderstandings or any questions, we answer it now before we start giving you more information. So,
Quick question. He said something about also Class C.
Yeah.
So,
Class C is us, the operators. So the Class A and Class B are the limited partners. Class C is us, who are the operators. So normally we would have only Class A and Class B, where Class A would be the limited partners, Class B would be the us, the operators, where Class A normally would have a certain split, whether it is 65-35 or 70-30 split, and then it was us, the operators. But here we have created three different classes. Class A, which is investors who get 10% flat. Then Class B, which is a 65-35 split, who get the cash on cash of 6% and the back end, and they make about 2x their money, whereas Class A makes only 10%. And then it's Class C, which is us.
okay.
Does that answer your question?
Yes, thank you.
Awesome. Any other questions? Okay.
that
So,
means you're doing a great job, Sanjay.
okay, I guess so. Just to let you guys know about what this really means, the offering summary. This is a 506B offering. Normally, there is a 506A and a 506B and a 506C offering. 506B offering is basically for both accredited and sophisticated investors. Class C offering is specifically for only accredited investors. So, just so for those who don't know what accredited investors are and sophisticated investors are, 506C offering is for accredited investors only. What does that mean? Is that if you have to be an accredited investor, you need to have at least a net worth of $1 million without taking your current residence or your primary residence into account. Okay. The second way you can be accredited investor is if you are single and you're making $200,000 annually for the past 2 years and expect the same this year and moving forward, you are considered as an accredited investor. If you are married, then it's $300,000. Okay. So that's for 506C offering. In a 506B offering, it is for both accredited investors as well as those who are non-accredited, or in our terms, we call them sophisticated investors. So who are sophisticated investors? Sophisticated investors are investors who are not accredited, but have a good understanding of what it means to make an investment. They have made some sort of an investment. They're educated. They understand the risks and rewards that comes with, investments, and so on.
I think
So
we may have another question, Sanjay.
go ahead.
Does anyone else have another question? I saw some mics get unmuted.
We had one. This is Steve. I had a question prior to moving on there. When it comes to the end of the 5 years, it isn't necessary that you sell it. You're going to try to sell it, but it may not sell. And then what happens?
That's a very valid question. Thank you, Steve, for bringing that up. So basically, you guys are the majority shareholders, right? As limited partners, you guys are the majority holders. But we are the operators. We understand this business. We are in this business. We keep our finger on the pulse on a daily basis, right? But you guys are the owners, right? So when it comes down to the 5 years, it's time to sell. Okay. We look at the market and we say, hey, Steve, and the rest of the shareholders, guys, this is a great time, and it doesn't have to be in the 5th year. We could do that in the 3rd year itself. If the market is really, really good and we can 2x your money in the 3rd year itself, why not, right? So, but both of the times we will talk to our shareholders, we'll tell them that, hey guys, this is a good time to sell, or this is not a good time to sell. Can we hold it for another year? Because guess what? This property is already cash flowing. You guys are getting your cash flow. So say for example, for those who have put in for that 10% guaranteed, they're getting that 10%. Those who are on the 2x their money on Class B shares, they're getting their 6% cash flow. But the thing is, if we sell it, we might not be able to 2x their money. So we'll be like, hey guys, how about we hold it for another year or so? Because right now, because of where the market is with the interest rates and so on, this is not a good time for us to sell. Can we just hold on? Now, it's a vote, right? But to me, it is a no-brainer. As long as you're getting your cash flow and you get your 2x your money, why would you want to just lowball it and sell it, right? But we still respect everybody's opinion, because at the end of the day, you guys are the shareholders of this particular property. So we definitely respect that, and we do a majority vote. Does that answer your question?
Well, sort of. I guess it looks like so Class B, you get 6%, and that could go on for more than 5 years. It could go on for 7 or 10 years. Then what's the guarantee that you're going to get that profit you're looking for when you sell it at that time? There isn't. I guess that's a risk you have to be willing to get into.
Well, yeah, that
Everything in real estate is always a risk, Steve. I'm sure you know that. We all know that. Anyone that wants to keep their money safe, keep it in the bank. It just is what it is, So one of those things that I want to be very completely honest with all of you. It's a risk no matter what. But what we do is take calculated risk. So we've been doing this collectively together with our team since the 90s, since before I was born, honestly. I know that Jim's been investing in this a long time. So we take very calculated risks. We do a lot of extensive research on our markets, on the properties, and what it is that we're going to be investing in. And we ourselves also invest in the properties. So this isn't something that we're taking other people and other investors and saying, hey, yeah, you go ahead and you put your money. We're putting our money where our mouth is. Okay. So we want this property to go just as smoothly for you guys as for us, because we want to make money on this on the investor side as well. So to answer your question, of course, there is no guarantee. There never is a guarantee. We just take very calculated and very strategic risk when it comes to investing in opportunities that are growing and in markets that are growing. So we like to do 3 to 5 years. If we can sell sooner, amazing. If we have to hold it for another year because the market's not looking great, then we do that. But one thing that you will get with Blue Ring Investors is that communication. We host our webinars. We make sure we give updates to our investors. If there's anything going on with the property, we make sure we communicate that with you guys. So there is no hiding behind an LLC or, you can never reach us again. This is why we do these webinars. We want to hear from you guys. And if there's any concerns or anything, when the property is progressing, we have these conversations with you guys head on. You'll get his cell phone number, my cell phone number. We've got nothing to hide. So it's just one of those things that if it's something that makes sense for you and you're ready to take that investment opportunity, then that's when this deal would be a great opportunity for you.
Okay, one more question on that. So what percentage of your investments over the years have you had to wait longer than 5 years to turn, like say 7 or 8 years?
We haven't had that situation so far. Okay. But you know how the economic times can be and how things can change and so on. So yeah, we just like to be very transparent that, and Steve, let me put it this way. Any investment, not only real estate investment, you put it in stocks and bonds. It's you're taking a risk, right? Yeah. But the good part about investing in a real estate, especially multifamily real estate, is that you're investing in a property, it's like a brick and mortar thing, right? It's there. There is a certain value to that particular building. It's always good that it will always hold a value, unlike your stocks and bonds, where today Elon Musk makes a decision that and he says certain things like, "Hey, I smoke weed." Damn, his whole thing just the stock just goes down, right?
Literally, yeah.
Or something else happens. Somebody says, "Oh, I'm going to put in X number of tariffs on somebody," right? Now, boom, the stock market goes crashing. That's not how it works with real estate. Like that particular place always holds a certain value. And as Catherine mentioned, it is all about you know doing your underwriting in a very conservative manner.
Yeah.
And that is what we do. We, unlike a whole lot of others, will not just buy for the sake of buying. If the numbers don't make sense, we just don't buy. Okay. Like for example, in 2023,
Mhm.
we just bought one property. That's it. Entire year, we just bought one property. That's it.
Yep.
The only reason, because it's not that we didn't have other properties that we could have purchased,
Yeah.
but we just did not feel it was right for us to, because the price was not right, and
Mhm.
we would not be able to deliver on our commitments. So
Yeah.
if we cannot do that, we don't buy it. So I don't know if that answers your question, but
Yep. Yep.
okay.
That's good. Thank you.
No, always a pleasure. Obviously, as we talked about the distribution schedule, it starts 10th month after close, which is why you probably would have had seen that, there was, we wanted to make sure that we are very clear. It takes us some time for us to stabilize the properties and actually start seeing some money coming in. So that's why we don't want anybody to think that, oh, as soon as I invest the money, I'm going to start seeing the money. That would be so unrealistic for us to say anything like that, because it takes some time for things to happen. Now we are very, very transparent in terms of where we are going to raise our capital from and how we're going to use that capital. Okay, so this is where the sources of funds are going to come from. So, capital contribution from Class A members, 575,000. Capital contribution from Class B members, $3.2 million. And from the bank, we're going to get $5.7 million. So basically, you have to remember, in our business, who are we leveraging on? We are leveraging actually on the bank. Okay, so the total source of fund is $9.6 million. And how are we going to use those funds? So what are we purchasing this property for? For 7.6, legal organization fees, yada, yada, yada. Like, it's all written over here. I'm not going to go line item by line item, but keeping all, and please note, we are also keeping money in the reserves so that if in case there is something that is need arises, we have enough money in there to make sure that we have taken care of it, right? So we are doing all of these, and it's coming up to that 9.6 million. So if you were to ask me, Sanjay, where did you come with this magic number of 9.6 million that you're going to come up with, the target sources of fund? Yeah, this is why we are coming up with that $9.6 million. Let's look at the property overview when it comes down to that. See, look at this, guys. It's a 2008, 2006 year build, the Big Springs, and the Lodge apartment is 2006 build. This is a really good property, very good age. Everything is to code. We don't have to do anything like, the older properties like 1970s, 1960s, even 1980 property where it is like galvanized pipes, aluminum, wiring and so on. These are like great. So if you look at it, this has got all of that, the PVX, copper plumbing, PVX in plumbing, copper wires and so on. Obviously, it's a pitched roof. Vinyl and brick is the framing. Built up, it's garden style, which is a good thing because that helps in the roofing when you're doing it, And look at the community amenities that are there. It's got a pool, skid play area, picnic areas, grills, and so on. Both of them have good things on both sides. Um, Average effective rent, occupancy. Honestly, I have to say this one. This is the fun part. Right now, on the Big Springs, we are actually at 98% occupancy. Okay, this was when we were actually when we had purchased the property, we had made it very clear we wanted to be at 90%, but the seller has actually taken it all the way to 98%. And on the Loveland, the lodge, we are actually at 90% at this given point of time, 90% as of yesterday. Okay, so that's what it is. There's ample parking. So all great things about this. Okay.
And another reason we look at all these things, guys, just so that you understand, like we're not just, excited about a property being 2008 or it having a pitched roof for no reason. These are all calculated things that we're looking for because it's going to go into the maintenance and the lifespan of this property while it's in our ownership. We want to make sure that there's no issues because the minute that a property has issues, the tenants start to get unhappy. And when you get unhappy tenants, you get vacancy and you start getting, a lack of rents. And that's when our investors don't get paid. So we try to avoid all those things by making sure that we position ourselves in a very strong place by buying properties that are very, very strong, very, they're secure. The age of it is good. It's got great amenities for families, people with children. So this is why we're looking at all these things. It's extremely important to be this anal and this oriented when it comes to looking at all these things on a property.
We always like to buy properties that have a good unit mix. So you would see this that it has got 1 bedroom, 1 bath, 2 bedroom, 1 bath, 2 bedrooms, 2 bath, and 3 bedrooms, 2 bath mix. And that's a good mix because now you can come in as a bachelor, then get married, have a child, and then hey, have another child. So you can actually grow in this entire property right from coming in as a bachelor all the way till you have a nice complete family. This is what this property looks like. Just a few things about this. We just wanted to show you the office space. So that's on the left hand side. What you're seeing is that it has this is the gym, and obviously this is how the rooms look like. This is what the property looks from the outside. Now whatever the property looks like, but it's the business plan that matters, right? So why did we feel that this is a good one for us to buy and for our investors, right? Obviously, we'll continue to, they have actually done the interiors as required with the proven upside rent potential. What they've already created a model that we know, because that's why I said, right, we wanted to get in at 90% occupancy. The reason why we wanted to go at 90% occupancy was also because we wanted to go with an agency loan and not a bridge loan, because bridge loans are more expensive and agency loans are at a lesser percentage interest, right? And we could get a better leverage for our investors. So that's pretty much what we did. But at the same time, we wanted to make sure that we have a proven methodology to this. So obviously, the current ownership has captured that 10 to 20% rent premiums on new leases. And obviously, there is an upside for at least $80 to $150 per unit that is there. We also have some other income that we have put in place, like current limited to no other income captures for apartment portfolio, but we have a potential to capture additional income such as application fee, admin fees, pest and trash fees, etc., which is totally legal for us to do it. That's what we're doing. And we are also doing that because all of our competitors in that area are already charging them. So we can do the same thing as well. We just want to let you know that both the properties are affordable workforce housing properties, not to be confused with Section 8 properties. Okay, this is not a Section 8 property. This is a strictly affordable workforce housing. Okay. Now, how are we going to use the capex? We're going to use the capex. We had already calculated that in our underwriting. We talked about it. How we're going to use your money. So this is what it is. One of it that was capex breakdown. So 200,000 towards the exteriors and $216,000 towards the interiors. And this is how it is going to be used. I'm not going to talk more about it because it's pretty much highlighted over here. Let's look at the financial summary, this is the important part. I want everybody to look at this and understand. Okay, if you can see that we are going with the market rent, the potential rent that we have, we are looking at $1.9 million in the first year. But look at this is the part that you have to look at. Upgrade rent increases. We have not taken any of those things. We are so conservative with this whole thing that even without doing any of the rent increases, we are still able to make this into a very profitable thing. Okay. Additional rent increases that we talked about in the first year, we are not going to even give them those rent increases that we are, the other income, like which you saw over here, that one, we are not going to give them in the first year, but we will starting the next year, and we have kept it very consistent. Okay. This is the thing that you have to remember. We have taken loss to lease into consideration, right? We are not trying to say that, okay, hey, there will be nothing, no losses or loss to leases that is going to happen, or the physical vacancy in itself. We have taken that also into consideration. Okay. And then we have taken also concessions and non-payment into consideration. We have taken a lot of these negatives so that we are being very, very conservative in terms of what the property would actually make. Okay. So those are the things that we are looking at. So that's where the other income we have put in, and we look at the total income coming to this one. And then obviously, it's not so much about the income, but then there are other expenses as well. So we have taken into the taxes in the first year, the insurance, because at the time of buying, we have to pay it in advance during the closing itself. That's why you're seeing negative over here, nothing over here. But then you see that we have, we have taken that into consideration. Obviously, repairs and maintenance, general administration, and so on. And this is what the net operating income is coming up to. Okay, so this is a nice pro forma that we have taken into consideration. We are being very, very conservative with our numbers and so on.
And this goes back, Steve, to like what you had mentioned, can you guarantee it? And, it's a very valid question that a lot of investors are always asking. I mean, when I first started, everyone loves a good guarantee, So as much as we would love to guarantee things, and we would be liars if we said, can we guarantee it? No, we can't guarantee it, but we can make sure that we are 99.99% sure that we've put in so many buffers to this budget that it would take a lot for something to go wrong. And that's why when we underwrite these deals and we are checking the numbers, and we spend a lot of time on these numbers, that we are adding so many buffers to, let's say hypothetically people don't pay, let's say hypothetically people break the lease, so we're adding all those buffers into these things. We're adding it to the vacancies, we're adding it to people not paying it, we're adding to any repairs that might happen, because again, life happens, we can't control these things. So all of these things, we're adding it on there, and if nothing happens, thank God, we're good, amazing, and we get a surplus and we're great. But if it does happen, we are prepared for it. Because you're going to know when you have a good team and when you have a good property management, not when nothing happens, because you can never tell. But when something happens and people know how to handle it, and we've handled a lot of messy things, that's when you know that you've got a good team that's taking care of your money. And that's the end goal when it comes to investing. So this just goes another way to show you guys how we take additional precautions to make sure that in the event that anything were to happen, the two major things being vacancies, non-payments, and honestly maintenance as well. If those things were to happen, it's buffed in here.
So let's go on to the next one is the loan
Steve,
terms.
did you have a
right?
question on that?
Oh, yeah. If anybody has a question, please, guys.
No.
Okay. Thank you. Guys, I just want to let you know, we don't want to rush this. We want to make sure that we answer all your questions and concerns, okay? Obviously, now the next thing is, the loan terms. The loan amount is 5.7. Loan to value is, we are getting it at 75% loan to value. Interest rate at 6.2%. Interest only period for 1 year. Fixed or adjustable, it is definitely a fixed one, and it's amortized for 30 years. Okay. Just again, coming back to Class A and Class B shares, what does the returns analysis look for? As I said, 10%, those who are going in Class A, they get 10% preferred. And honestly, that 10% is, they get the preferential thing. They get taken care of first, so they get 10% guaranteed. So those who say, I want a guaranteed 10% kind of a thing, preferred return, there you go. That's for you. But those who are like, hey, I'll be, I'm young and I'm able to wait, and I'm willing to take certain risks. Guess what? And I can 2x my money. There you go. That's Class B shares for you. Okay. So that's what it is. Obviously, we talked about the, waterfall structure. Because we have got this property at such a discounted rate, we are feeling so good about it. We felt we need to have some sort of a waterfall structure. Why? It's because obviously distributable cash for all years of operations will follow a split of 10% to Class A members, and then a 60-40 split between Class B members and Class C members. If, okay, that is, these are the things like, up to 10% ARR for Class A members, beyond 10% ARR, up to 20% ARR for Class B members. Total proceeds will be split 65-35 between Class B members and C. After 20% ARR, split at 50-50. What does that mean is, for Class B members, is like, once we have crossed a certain threshold, like we have promised you, we have given you, we have 2x your money and so on. And if it's going to go up beyond that, we are like, hey, we worked very hard to get there. So anything, once we have doubled your money, anything above that, it's going to be split at 50-50. That's pretty much what it is. And I think it's a fair thing to do because we have already 2x your money, and anything above that is what we are just being partners on this one. Okay. Obviously, we have managers' fees and so on that we will be charging, but it's all part of the underwriting. It's nothing coming out of any of the things. This is already part of the thing, but we like to disclose everything ahead of time so that, okay, hey, we'll have a one-time acquisition fee, then we'll have a yearly asset management fee, and we'll have a transactional fee of 1% of the loan if we refinance and so on. All these things are already taken into consideration in the underwriting, but we just want to make it very clear that that's what it is.
Any questions on that waterfall structure, guys? I know that may be a new term for some of you. Going once, going twice. Okay, again. Nope. Okay.
Market comparables, right?
Wait, we have a question. Hold on.
Okay, go ahead.
Wait, Naomi, did you say you had a question or no, you're good?
No, no, we're good. But I do slightly have a question actually, now that I got listed
Right.
here. How are you guys getting it at a discount price? Like, how did that happen? If you
That's a
could
great question.
explain. I would love to hear.
That's a very good question, very valid question as well. So this is a LIHTC property, right? It's a low income tax credit kind of a property that we are buying. Okay, so what does that really mean is that the federal government and the city and everything, they are always looking for building properties in places where they can actually bring in more population, more industries, and more growth, and so on. So, what does it mean for the person who is building the property? What's in it for him, right? At the end of the day. So, when these guys build it, usually this LIHTC properties are LIHTC properties for like 30 years in most of the states, but in the state of Texas, it's for 40 years. Okay. But the tax credit and all of those things, it is only valid for 15 years. So as the guy who is basically into construction and so on, and he puts in all this money, he gets all the tax incentives and so on for 15 years. After 15 years, he has already squeezed out everything out of it. Okay. And he's got nothing to benefit. He's not an operator. Okay. Like us. He's just a construction guy. He's the guy who puts everything together. He takes out all of his money. He squeezes out all that money, and boom, he's done with it. It doesn't benefit him holding it for the next, say 25 years or so, right? So what does he do? He is going to sell it. Now, when he sells it, he's going to sell it at a very discounted price because he doesn't want to hold that property. But in this particular property, you would have noticed is that about 5 years ago or so, there was a big flood and all of those things happened, which kind of, there was a lot of, not a flood, but there was a flood, but also there was a lot of other things that had damaged the structure. And the guy did not want to rebuild rebuild the structure or the roof or the windows and so on. So guess what? There was this gentleman who is the current seller who's selling it. He just, went to him. He said, "Hey, man, I'll do all these things for you." Now, what does it mean for the guy who was having this before? He was like, "Hey, I already squeezed out everything. I got all the tax benefits out of it. Now, I'm just going to, I'm not going to invest more money into this. So I'm just going to sell it to this guy at a really, really discounted price." And that's pretty much what happened. Now, the guy who bought this, his modus operandi is very simple. He is a contractor. He buys properties. He's not an operator. He doesn't hold it for a long period of time. He buys the property. He creates a scenario where he creates a proof of concept, and then he just sells it to someone like us who are the operators. And that is why we got it at such a discounted price.
Is that kind of like wholesaling in a sense? Would that be considered?
No.
No? Okay.
No, it's not. So basically what happens is in a LIHTC kind of a property, right? The way it normally works is when we talk about tax credits, right? The government kind of encourages the builder to build it so that he builds that, and then that particular community or that particular area gets more people coming in, better housing for those who don't earn a whole lot of money. Like, say for example, what does it mean? Say for example, if the median income in that particular area is about $100,000. But what about those who are at 60% of that money? So say, for example, you are earning $60,000. Okay. So all of those people who are making $100,000 in that area are living in a nice property where they're paying about $3,000 per in rent per per month. In this case, the government incentivizes for that person who's making $60,000, okay, and says, hey, we will give you a nice, affordable living at half the price. So basically, they are trying to help those. And again, as I said, this is not Section 8, okay? It's not Section 8. Here, you have an opportunity to have a better lifestyle at a lower price.
That
And
makes
that's
sense.
what it is. So the beauty about this whole thing is those who are making that $60,000 who are within that range, guess what happens? They're getting a better place to live in, okay? Just as comparable as those who are paying $3,000, okay? And they pay their rents on time because if they don't, then they have to pay twice as much somewhere else. So that is the beauty about having this kind of place. And the reason why we are going after this is for two reasons. Number one, with the economic conditions that where it is today, where a lot of people are having challenges, this is a great place to be in because there are two things. One is you have those who are making that 60% of the median income over there. Plus, the city also helps them to make for the difference if they really need help. So this is where we are in a great, great, great place where we are not only building a great community, but we are not going the Section 8 way where it's all federal given and people are not paying anything, they don't even have a job and so on. So this is the beauty about this particular place. Does that answer your question?
Yes, thank you so much.
Okay. Now let's go with the rent comparables, right? This is the beauty about it. This is why I said what I said earlier, right? If you look at this is a 2008, 2006, this is a 2016, one of our competitors. And then if you really look at it's all 1980s, 73s, 70s, and so on. And if you look at, from the effective rent, we are really, really, very, very competitive. Okay. That's why we feel so good about it. The same thing with the lodge apartment is the same thing. It's a 2008. Every other apartment around in that area is a lot older. And we are still very, very competitive in terms of our rents. The market overview, obviously why we want to invest in this particular place and so on. So this gives you, a low cost of living, affordable housing, and low commute time are some of the many benefits of life in Big Spring. That's the beauty about it. Okay. The largest employer in Big Springs are in the healthcare sector. That's a good thing. Okay. The same thing with a whole lot of other things that are there out here. I'm not going to bore you with all the details, but this is what it is if you really look at it. Okay, Veterans Administration Hospital, Big State Hospital, Medical Center, and so on. We go with the Levelland thing again. If you look at it, the city of Lubbock, we already have a property over there. Is only 30 miles to the east. Okay. So, Lubbock is, it has got the University of Texas over there and so on. It's, we are doing great in that area. This particular property with the benefits that it has, a lot of people coming over there and staying over there because it is closer in terms of transport and so on.
And this is another reason, you guys, that we're so confident with these two properties because we already have properties in Texas and we've got property management in there. We know the area very well, so it's very beneficial for us to just continue to purchase within the same areas because it just makes more sense. We've got property management, we got the setup there. We're not trying to conquer every single market in every single state. We want to go where we know, where we like, and where we trust. And we know that the Texas market is extremely strong and it continues to grow every day. So that's another reason that we're really excited about these two properties as well.
Yeah, and guys, we are not all these economic announcements. They're all the sources are given to you right here. There is more investment coming in these areas and so on. Honestly, I was surprised that I did not know that. I always thought that these areas were known for oil drilling and so on, but I did not know that they are the biggest cotton producers. I had no freaking idea about that one until I actually went there, and I was like, wow. When I first walked in, I thought, well, were there ice cubes falling over there, or was it snow? But no, that was not snow, it was cotton. So
You
wow.
learn something new every day.
We learn something new every day. But yeah, there is more to this. These are the resources that talks about the economic announcements that's happening. All these people are willing to put in more money into that place, which is a good thing, and so on. All these things are on the web, so you can actually, let's say the top 5 cotton producing counties in Texas. Who knew that? So all these things, like, in 2022, U.S. cotton exports expanded to 8.9 billion. I did not know that. I thought we were just great in beef and everything. But man, this is good. A lot of things that we learn every day, and we just like to share it with you guys. The management team, as I said, it's important to invest with people who have great experience and have managed the property very, very well. I say this because a lot of people look at numbers and they say, wow, the numbers look great. You know what, at the end of the day, anything can look great when it comes down to numbers. But what you really need to stay focused on is who's really managing that property for you, who's using your hard-earned money. And this is where the expertise kicks in. And this is where I always say that a good operator can even make a bad looking property great, or a bad operator can take a great property and make it look really, really bad. We are very fortunate that we have great partners. And obviously, I would like to talk about Jim Stewart over here. He started off with 8 units in 1991, and he's got 3,000 plus units right now, and so on. Pretty much is a great portfolio, multiple cycles, and so on. Obviously, the next one is myself, and then we have Ricky also in this, from Kia. In there, we have Dr. Jeanette, who's one of our partners in Blue Ring Investors, and a very successful person. And Catherine, you want to just talk about yourself? I don't want to.
No, I mean, there's not much to know. I'm here, I'm in Tampa. I love what I do. I'm also a broker here. And I flip houses. I've pretty much done it all. Flip houses, buy, sell, broker, and you name it, I've done it. So if there's anything you guys need, I'm always here at your service.
Awesome. So you want to walk them through this, Catherine?
Absolutely. This is my favorite part, you guys. So hopefully we did a great job convincing you guys that we're amazing, because we are. So if you guys have any other questions and you need to talk maybe one-on-one, feel free to go ahead and just schedule one-on-one. Let me see if I can do we have our Calendly on here? Because on Blue Ring, there is the contact us. I just want to put the link on here so you guys can reach out directly. Here it is. Schedule a call. So I'm going to send this to you guys here on your link. If you want, just scroll all the way to the bottom, and then you're going to click on schedule a free strategy call if you have any questions. If you don't, I also, on the same link, you can join the investor portal. And that's where you're going to have access to your things, right? So you're going to create your account. You're going to see all the documents pertaining to this particular property on your portal. You're going to review it. And then from there, you'll get to subscribe. You'll get to do your PPM, which is your private placement memorandum. That is all the legal mumbo jumbo that you need to be able to say that I, as a person, want to invest in this deal. You can also do it as an LLC. There's many other ways that you can invest in it. Again, I think it's if you want to get into more technical things, we can schedule a private call. But essentially the way that it'll work, and of course, all of this is downloadable, so you can take it to your attorney, CPA, advisor, whoever you need to talk to. You can take all of it to them. All of it has been completely done with our attorneys, so it's all by the books. And then once you do that, then after you've signed it, you will go ahead and receive the wiring instructions. And from there, you will wire the funds. Now, keep in mind, because this is something that is kind of a sore subject with a few investors, just because you sign the papers does not mean that you are getting a place held, okay? We are raising, correct me if I'm wrong, $3.8 million. And it will fill up fast. If it fills up fast all the time, and I've had the conversation with some investors that they will sign their stuff, and unfortunately they end up sending the money too late, and we get filled up. And once we get oversubscribed, we will have to send your money back. So unfortunately, it's not us. It's something that's more of a first come first serve, and it's not just us raising funds. It's a big team of us that's doing it. So if they get their investors' money in first, you're going to have to wait for the next deal. So just make sure that as soon as you fill out the paperwork, you've gotten all your questions answered, and you receive your wiring instructions, that you wire the funds, and then you'll be good to go. If you don't, then unfortunately you'll have to wait for the next deal. But that it's super easy. And then after that, after you've wired it, for this particular deal, month 10th is when you're gonna start receiving the quarterly distributions. Part of you creating your account is you adding how you want to get paid. You can get a check in the mail, you can add your wiring instructions, and we can do a direct deposit. However you'd like to do it, we can do it that way. And then from there, you'll just start receiving quarterly distributions. And whenever we have a webinar to update our investors on that particular property, we'll send an email to you guys, and you can go ahead and join the webinar. And if you have any questions on the property, you can ask it freely. And then after that, it's just I think the last thing is just the depreciation. They'll get their K1s in the mail, and then from there you give that to your CPA people, and you deduct your the depreciation. So it's super easy. We really wanted to streamline this for you guys so that it's passive, okay? You having to do all the work, that's not passive. We wanted to make this so that you don't have to deal with anything. You can log onto your account, you can look at your money whenever you want, you can have access to your documents whenever you want, and you have access to us when you need. So we wanted to make it very simple. And if there's anything else you guys need, I think this is the perfect time to ask any final questions before we wrap up, because I know it's pretty late. It's 10:13. So any final questions?
Nope.
Did we do a good job answering everything you needed?
I loved it. It was awesome. Wonderful.
Yay. Awesome.
Informative.
That
Yeah.
is what we are in business. So here is, just to clarify, minimum investment on this one is 50,000.
Yeah.
I think we're everything is due.
227. Yeah, we changed that. Yeah.
Okay. Yeah, I think we have like 2 or 3 more weeks. So for this particular deal, we've got a few weeks left. If you can't get on this one, no problem. We'll have another one soon enough. So just make sure that you at least join the investor community so that you are informed of when we have our next deal. So if no one has any final questions,
I'm going to stop recording, then
Yes.
we can ask more questions.
we will bid you guys good night.